All right, coming up next, I'm excited for this next one. This is a company that I personally have seen a lot of interest in and have never really gotten a ton of time to learn about. So I'd like to welcome on the CEO of Tilt Holdings. There he is, Gary Santo. Gary, how are you?
Good. How are you doing?
I am doing well. Thank you for asking. Your company is on the OTC and the ticker is TLLTF. That is correct, right?
Yes, it is.
All right, I will let you take it away. I see your slides. They are looking good. Have at it.
Awesome. Thank you so much, Brent. And thanks, everyone, for tuning in for our corporate presentation today. We just completed our third quarter and reported on that a few weeks ago, so we've had a chance to update this new deck. The full version of this deck is available up on our website, which is www.tiltholdings.com. But I'd like to really spend the next 15, 20 minutes or so just kind of walking through who we are and what really makes us different from a lot of the MSOs you see out there. So jumping right in, we acknowledge that we are a different sort of MSO. And I think one of the things that makes us the most different is about half of our business does not touch the plant. So out in Arizona, we have our Jupiter Research Group, which is inhalation and accessories. So packaging, the hardware for vape, so battery packs and empty cartridges. And that's a very healthy business we have. And we stand behind all the brands, the MSOs, and the Canadian LPs in providing them with hardware really in one of 3 or 4 ways. So you can get a customized piece of hardware, so something bespoke. It could be a mouthpiece. It could be functionality on a battery pack. We could give some of our existing stock product on a white label basis. So maybe it's a badging or some type of decal or something you'd like put on there. Or we do have our Jupiter and CCell branded products. So if you're just looking to carry a non-branded product, we can bring that in as well. But what's key is Jupiter has been an incredibly profitable business for us since day one, and it's been selling B2B that's made it that way. Now, we don't own the IP necessarily. We have certain patents, and there are certain products that are specific to Jupiter, but they're all tied to CCell. So that's that ceramic heating cartridge, that is used out in the marketplace, and it's a dominant player in the space. We partner with the factory out in Shenzhen, China. Their name is S'more. They own the IP. They are our manufacturer. So because we are a distributor and an R&D shop, that part of the business doesn't look quite so much like an MSO when you think about margins and when you think about, overall, dollars of profitability. So you're probably talking mid-20 gross margins and low to mid-teens on the EBITDA margins. But as we look to the other half of our business, which is plant touching, and that's in Pennsylvania, Massachusetts, Ohio, and we're soon to enter New York, those are more typical MSO style margins. So 40, 50, 60% gross margins with 30 or 40% EBITDA margins. I think the challenge for us, however, has been how do we approach those other states that we're in? Is there a way to take that B2B business that has been so successful in the hardware side and really apply it to the plant touching side? And traditionally, you see people talk about doing wholesaling. And I think that's been more on the bulk flower sale or even contract manufacturing ways of doing things. And those are interesting, but honestly, they're not, I think, very deep in the market. So if you think about wholesale in general, it has changed dramatically, especially in those East Coast markets we're in where maybe a year ago, I could sell bulk flower in Massachusetts for maybe $4,000 a pound, just put it in a bag and it would sell. That same bulk flower is probably closer to $3,000 or maybe $3,200, depending on your potency. But if I were to take that same pound and turn it into packaged eighths, I can now recapture that delta and probably make a little bit more. So we believe the market is moving away from that bulk wholesale and moving into the consumer packaged goods world. So there will be brands, they will start to come out. And I think eventually there will be a Coke and there will be a Pepsi. So then the question becomes, okay, do you build the brand on your own? Or do you try to partner up with folks? And in that case, are you now just a contract manufacturer? And for us, the big issue we see with contract manufacturing is if I'm just following someone else's recipe and their SOPs, I'm really incentivized to do the minimum amount I can to hit those SOPs while protecting my margin. I'm not really looking at distribution. I'm not looking at whether or not those products are right for the market. I'm just following directions. And to us, that's not really interesting either. We want to leverage the fact that we understand our markets. We have a great distribution chain in there, and I'll talk a little bit more about that in a minute. So our goal has really been, let's take that knowledge and let's partner up with some of those really good brands, and even with the MSOs out there who are trying to get their own brands more, well distributed, and let's see what we can do on that front. And that's really the business model that we launched early this year. So being that B2B player, supporting the MSOs, supporting the LPs, and supporting the brands, and trying to really create a nice distribution network on the East Coast that marries up with our hardware so that we have great cross-selling capabilities. So as you can see on this slide, pretty much a rundown of our basic vitals. I won't really spend time there as you're all able to see this, but suffice it to say we have a significant amount of growth capacity on our plant touching side. Right now we have roughly about just a little under 100,000 square foot of cultivation that is active. We have room to grow significantly. In Massachusetts, we can double our cultivation one more time and go up to the max. In Pennsylvania, we can more than double our cultivation if we'd like to. And we're in the process of building a facility in New York State. So as I mentioned, we believe that CPG is where this market's going to go. And you can see some of the brands here that we work with. Some are in-house brands. Most really are third-party brands and names you might recognize. But what we found is in talking to some of these brands, no matter how successful they've been in their core markets, scaling that brand has proven to be a challenge for most, because how you sell in California is going to be different from how you sell in Massachusetts. Could be the packaging, could be the formulation, could be the form factor. Certainly in medical markets like Pennsylvania or Ohio, that is most certainly the case. So being able to work collaboratively and figure out how do we keep that brand fidelity and bring it from the West to the East so that the experience you have in the East is as close as you can get to what you had out West while still being regulatory compliant. And this has been the place where I think so many brands, especially independent brands, have struggled because they don't have that knowledge base. They don't have teams on the ground, and it becomes very expensive for them to really try to do that when they don't have a license to operate in those states back east. So for us, we see a tremendous opportunity there to sort of be that middle market manager. So managing the supply chain, managing the regulatory, managing the distribution, so that really all our brands have to do is focus on who they are, what their brand architecture is, and then continue on both the product development side and on the marketing side to keep those brands relevant in the marketplace. So in terms of what our value proposition is, there's really four main pieces. As I mentioned, we can do wholesale flower. A year or so ago, that's exactly what we were doing, selling bulk flower. We think those days are sort of behind us now. And while we still will opportunistically sell bulk flower, we really look to sell more specific strains, more packaged flower, and turning much of that flower into packaged goods, whether it's pre-rolls, whether it's packaged eighths, whether it's turning into concentrates or edibles. So with Commonwealth Alternative Care, that's our Massachusetts operation. And then Standard Farms, which are our operations in Pennsylvania and Ohio, we're able to bring all of that to market and really sell to all the retail outlets, whether you're an MSO or whether you're a standalone independent retailer. Product development, that's also an area that I think is a differentiator for us. So you think about what we can do to develop our own products. So in Massachusetts and in Ohio, we have a full commercial kitchen set up. We can do pretty much any edible you want. We have extraction labs in all three of our locations in Pennsylvania, Ohio, and Massachusetts, and we're in the process of standardizing all three. So we have the same extraction capacity and capabilities. So whatever extraction method you use, we're able to actually match up to that. And it allows us then the ability to work together collaboratively to not only develop maybe some of our own products, and historically that's what we've done, but to work with our brand partners. And Old Pal comes to mind. They're one of the brands we signed this year, and they wanted to enter Massachusetts and Pennsylvania. They have their standard flower packs ready to roll. We were able to do that. That's not a problem. They have their vape carts, and we're able to do that and even support that with Jupiter hardware. But they were looking to bring an edible to market. So they were able to give them run of our kitchen. They ended up developing a brownie. So it's working with our brands to see what has to happen to their existing product suites and then what might need to be developed as a new product and a new SKU that will help them continue to grow that brand, but stay true to that brand fidelity. So we offer that across the board, including at our hardware manufacturer. So we talk about Jupiter. Again, we can create products on a bespoke basis. So if it's a certain design you're looking for, whether it's the size, the length, the size, the color, we can do any of those things. We can even fine tune our hardware to match up to the various concentrates you might use. So if it's traditional distillate, if it's waxes, if it's shatters, if it's resins or rosins, we can work with you to really fine tune that hardware. Then we have the hardware itself and the packaging. Again, the packaging is available really not just for our vape cartridges and vape hardware, but it's also available for all of our cannabis products out there. So we have both partnerships and in-house capabilities there. And then we do have the contract manufacturing I talked about. We're able to do that. Like I said, it tends to be more of a partnership with product development. but we certainly can do contract manufacturing. But I think a key differentiator here is that distribution network. So as you heard me talk about earlier, most contract manufacturing, you produce the product and you give it back to the shop that you contracted with for them to actually take care of the sales and marketing. So these brands have to put sales organizations in place and boots on the ground in these states. Well, here we're giving all of the brand partners run of our sales and distribution. So in Massachusetts, we reach about 80% of the retail stores out there in addition to our own 3. In Pennsylvania, it's closer to 90%. And in Ohio, we're just getting started, but we have access to all 57 operating dispensaries. So now as a brand, you have a turnkey solution at the end of the day that allows you to really come in. Let's talk about the products. Let's talk about the formulations. You get about the business of promoting your brand. We'll take care of everything else, including how that brand gets on the shelves. So it really becomes a cost-effective partnership between brands and between TILT. So this is an example of a case study. So Arrow was one of Jupiter's first customers. They have an exclusive contract with one of our proprietary devices. It's called the L9. It is a C-cell powered device. It is a closed loop system, so it does have a pod, and they have the distribution rights throughout the U.S. They brand it as Arrow, and they have custom formulations in all of the states that they have, and they operate in. And to date, they have been really going with third-party manufacturers to create the oils and then to fill the cartridges and help them distribute it. So it's required them to build out quite an infrastructure in those states and then come up with good contract manufacturer partners. As it turns out, they wanted to come into Pennsylvania, so it was only natural. They're already buying the hardware from us. We gave them access to our Pennsylvania shop. We've already launched them and rolled products. So when you think about the places we now, touch Arrow and how Arrow, folds back into us, we've been selling them the hardware really since the first early days of Arrow. Now in the state that we're in Pennsylvania, and we recently announced expanding to Massachusetts, we're able to take that hardware, fill the cartridges, adhering to the formulations that Arrow has designed, put that into packaging, and then help distribute that throughout our network. So now one brand is touching all parts of our business, the cannabis side, the packaging side, the distribution side, and the hardware side. So when you look at what that means, we began this year with about 20% of our revenue just by happenstance occurring with customers who touched both our plant touching and non-plant touching businesses. And that was, like I said, it was not by design. It was more just how the legacy businesses had evolved. This year, since we went into this intentionally, after about 3 quarters, we're already up to 40% of our revenue coming from the cross-sell opportunity. And that's really reaching out to those brands that might be purchasing hardware and opening up our markets to them, or even just opening up certain SKUs and product lines to them in the markets that we're in. And it's been incredibly successful for us to this point. So in terms of the plant touching assets themselves, as I mentioned, we're in Pennsylvania, Massachusetts, Ohio, and we entered into a partnership with the Shinnecock Nation, which is a phenomenal social equity story, I think, in the sense that this is a facility that will be owned by the Shinnecock Indian Nation. They will own it through and through. So this is not one of these management services agreements where somehow the MSO takes ownership afterwards. We will build out, we will train up, and we will help manage a fully vertically integrated operation, about 60,000 square foot of cultivation and manufacturing, as well as a dispensary which will be on native grounds. Our hope is, as the regulations in New York continue to evolve and wholesale becomes part of those, we'll be able to then sell product not only just on the proprietary land, but also be able to sell off land throughout all of New York State. So we think that's an exciting one. About 75% of the free cash flow will flow back to the Shinnecock Nation. We'll still be making a very good amount of money off of that. I think so there. It's a great partnership that we think can set the stage for more partnerships, like whether that's on a social equity basis or even just how we look to enter other states. We're not having to plant flags in such a way that we're going to spend millions upon millions of dollars. If there are ways to do constructive partnerships where everybody wins and we can keep the investment costs low, I think that's a great return for our shareholders. In Massachusetts, we're fully vertical. We have 3 stores. Our Brockton store just was approved and had a grand opening. So they're adult use and medical dispensary. They opened in October. In Taunton, we have our final inspection scheduled, and we look to be able to add adult use to our existing medical dispensary there before the end of this month. And then in Ohio, and then we have a Cambridge store, which we're waiting hopefully till I think the first quarter of next year. We hope to get that fully operational. We also have cultivation and manufacturing. In Pennsylvania, it's cultivation and manufacturing, so we do not have a retail presence. There we have roughly about 33,000 square feet of cultivation space, and we're able to distribute throughout the state. And then Ohio, it's just manufacturing. We have a great line of sight on biomass. I think over time, maybe we might want to look into what we can do for cultivation there. But we're pretty excited. We took ownership of that facility earlier this year, so we're just getting started. On the inhalation side, you heard me talk about Jupiter. So there, we work with over 700 cannabis brands. And again, they're Canadian LPs, they're MSOs, they're also independent brands. So, we are the largest CCELL distributor with about 50% of their market share. We estimate that translates to about 30% of the market share in terms of all in vape. And we have an active R&D lab in Arizona where I'm sitting today. So one of the things that makes us different is we helped bring CCELL into the U.S. Prior to our involvement, CCELL was being used predominantly on the nicotine side and the tobacco side. And Jupiter's founder, who was the chair of our board, Mark Scatterday, worked with the factory for a few years to really alter that technology so that it applied better to the cannabis distillates that were available. And we continue those developmental works today. We have staff sitting out in China. The S'more labs have people sitting in our facilities in Arizona. So it's very collaborative, much different than just being a pure distributor. In terms of how we interact, as you can see here, CuraSelect, this is the premium brand for Curaleaf. They use all Jupiter hardware, so we have the cartridge, we have the battery, and then we ship those over to them on a customized basis. They take care of filling it and putting it into the packaging and then distribute it. So in addition to the 700 brands supported, we're in 36 states and 15 countries. So we have a partnership that brings us into Israel, into the UK, and other areas throughout the world. It's a much cheaper way for us to really reach our expanse because it costs money to set up distribution networks in those other countries. To tap into someone that already has those, we think is a very intelligent way for us to do that. We work with 4+ major LP customers and over 15 major public and private MSOs. In terms of the finances, so really for us, 2019 was the year of stabilization. So the company had undergone some significant changes to management. It was about really stabilizing the core and exiting 2019, being able to fund our operations purely out of our own cash flow. We have not gone to market and raised capital since 2019. And really then, even all the dollars we raised were spent to refinance existing debt, not to put dry powder into the bank to fund operations. As we went into 2020, then it was starting to focus more on profitability. And as you can see, the swings here on our adjusted EBITDA from negative 0.8 to almost 17 million positive from 2019 to 2020. Similarly, the cash from operating activities changed significantly, going from just under negative 18 million in 2019 to just under 17 million positive in 2020. So the good news there is we have tremendous amount of organic growth as we continue to scale our operations that we're able to fund internally. And then really, when you look at the prior investments that were made, I talked about that Cambridge store. I talked about those other stores that we opened in Massachusetts. Those were already built out. Those were just waiting for licenses to be issued. Similarly, our shop in Massachusetts has been fully built out. So there, it's been more about maximizing the assets and getting the most throughput. We doubled our cultivation space earlier this year. We went from about 25 or 26,000 square feet to 56,000 square feet. So it's about activating that space. It's about getting efficient in that space and sweating the assets. So in summary, I think when you take a look at Tilt, we are poised to grow. There are some new markets we'd love to get into. I think now we're able to start to look at the inorganic avenues for growth. But 2022 is going to be about sweating our existing assets and continuing to deliver the solid quarters that we've delivered so far. So I don't know, do I have any time left, Brent, for Q&A, or have I burned through it all?
One quick one, if you don't mind. We had an astute viewer in the audience who asked a good question, and you just had the slide up there about your guidance. And the viewer wanted us to check in on the guidance. Does it seem like it's on track for fiscal year 21?
Yeah, so we restated our guidance on the revenue side. So it was 205 to 210. We did guide folks at, like the other MSOs out there, will probably be towards the lower end of that guidance. We did change our guidance on the adjusted EBITDA, and it's now 24 to 26 million. So we still feel very strongly on that front. And really, that's been because Jupiter has been a little bit bigger part of our business as our plant touching assets have continued to scale. And then also, I think just some of the inherent costs with Jupiter on the shipping side and a little bit of the softness that I think the other MSOs have seen, on their side. If we're selling into them and they're seeing some slowness of sales, we're assuming there'll be a little bit of a trickle down impact.
Got it. Makes sense. Thanks a lot for that, Gary. Gary Santo, he's CEO of Tilt Holdings. It's ticker TLLTF on the OTC. Appreciate you being here today, sir.
Great. Thanks so much, Brent. Pleasure as always.
Yes, sir.